You're listening to AI PRISM from Seoul Economic Daily.
It's Tuesday, May 12th. I'd like to share some thoughts about finance daily.
Right, let's get into it.
So imagine a government trying to protect consumers from predatory lenders. But their rules are so strict that they accidentally push borrowers directly into the arms of the criminal underworld.
It is a textbook unintended consequence.
Exactly. And it is playing out in Korea right now. For anyone watching global finance, it's a perfect test case of what happens when regulators squeeze one end of the market while technology rapidly reshapes the other.
It really starts at the bottom of Korea's tiered lending system. So below the major banks and savings banks, you have registered money lenders. But to legally lend, a firm needs 300 million won.
Which is about 220,000 US dollars, right?
Right, in capital. Plus, they face a 6-month wait to get approved by the Financial Supervisory Service, the FSS. And the FSS only has roughly 20 staff to oversee nearly 970 lenders.
Oh, wow. 20 staff for almost 1,000 lenders.
Yes. It is a severe bureaucratic choke point.
And the numbers show this regulatory mechanism is actually creating a crisis. Legal loan volumes plummeted by roughly 20%, dropping to 12.45 trillion won.
Or $9 billion.
Right. It's like tightening the valve on a legal water supply. I mean, the man doesn't vanish. People just drink from a poisoned well instead.
That is a great analogy. Borrowers are turning to the Sachi market, which is Korea's illegal private lending gray market. Reports of harm from these illegal loans jumped 27.5%.
That is awful. So what is the policy option on the table to fix this?
Well, the proposed fix right now is purely administrative. They want to delegate the initial document screening to the Korea Federation of Savings Banks.
So that would finally free up the FSS to focus on actual supervision.
Exactly, rather than just processing paperwork.
So while regulators are accidentally strangling the bottom of the credit market with red tape, they are simultaneously forcing structural changes at the top of the financial food chain?
Right, the fintech ecosystem.
Yes. Let's look at how fintech giants are reacting. Global payment margins are compressing, forcing Korea's dominant digital wallets to Naver Pay and Kakao Payday to find new revenue streams.
And they're taking completely diverging paths here.
Naver Pay is chasing offline merchant data, right?
They are. They processed 24.2 trillion or $17.5 billion in the first quarter alone. And they're rolling out physical payment terminals to 4,000 offline retail stores.
Wait, hardware. Is Naver's hardware-heavy offline push inherently riskier than Kakao's digital wealth distribution model? I mean, deploying physical terminals requires serious capital.
It is absolutely riskier up front because, hardware eats capital. Naver is making an expensive bet that owning offline physical transaction data will feed their broader search and e-commerce ecosystem.
Making those terminals worth the initial costs.
Right. Kakao, on the other hand, is taking the leaner route. They are pivoting to wealth management and insurance distribution. Because their messaging app is already installed on almost every Korean smartphone, they can distribute products with zero hardware overhead.
Oh, that makes sense.
Yeah. And their financial services revenue jumped 82% to about $106 million. Their securities assets hit 13 trillion won, or $9.4 billion.
Kakao's aggressive move into insurance distribution leads us perfectly into the structural issues plaguing Korea's traditional insurance market. Legacy systems are really struggling to adapt.
Which brings us to Yebyeol non-life insurance.
Right. The Korea Deposit Insurance Corporation, the KDIC, is currently on its 7th attempt to sell it. Explain what Yebyeol is for listeners who might not track Korean insurance.
Sure. Yebyeol is a bridge insurer. Think of a bridge insurer as a financial landfill. It holds the toxic, abandoned policies of failed companies until the government can find a buyer willing to clean it up.
But right now, no one wants to buy the landfill.
No. 7 sale attempts is incredibly slow, though Hankook Fire and Marine is currently reviewing whether to bid. That might finally create a competitive process.
Look at the contrast here. You have the sluggish auction of an old-world asset on one hand, and the sudden forced modernization of digital claims on the other.
You were talking about the Silson 24 app.
Exactly. For 14 years, the industry debated digitizing Silson, the private supplementary indemnity policies. Now, the Silson 24 app lets patients send hospital paperwork directly to insurers.
But the primary challenge there has been provider adoption. Right now, only 29% of clinics have their back-end systems hooked up to this app.
That seems low.
It is, but by bringing in GC Media AI, which provides the electronic medical record software used by thousands of doctors, that automatic connection jumps to 52% overnight.
Oh, wow.
Yeah, and their ultimate target is 90% coverage.
It brings a level of data clarity the system has literally never had. As this ecosystem shifts, I want you to consider how the radical transparency and efficiency of a system like Silson 24 will ultimately affect the profit margins of those legacy insurers, the same insurers who are busy trying to absorb those distressed old-world assets. That's today's AI PRISM Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.